G'day and welcome to the Grow a Small Business Podcast. I'm your host, Troy Truen. Each week, we speak with an owner who has grown a business with 5 to 30 team members to something bigger. Diving into their numbers and unearthing the pain they've experienced, we explore what they did to overcome each barrier and what they would do differently from day one. Let's get into it.
Welcome, everyone. Today I'm interviewing Greg Crabtree, who is CRE Simple Numbers. He's one of the founders, I think. Greg, is that right?
I founded my original practice. We then merged with a national CPA firm. I started my practice in 1986 and created the Simple Numbers concept prior to then merging with Carr, and Ingram in 2020.
Yeah, nice. And author as well, and you're based in Alabama in the USA. So thanks again for your time, mate.
Yeah, I appreciate it. Thanks for inviting me.
Today we're going to be chatting about understanding your numbers so you can improve your profit. Obviously, very important concept if you're running a business. So tell our audience a bit about yourself and your experience on this topic.
Yeah, I always like to say, I'm kind of a recovering accountant. I really hate accounting. I grew up having to learn the tool, and then it's like, is this it? There's got to be more to it. And my natural curiosity kind of led me down a path of really trying to develop a skill set to display numbers in a way that they tell a story, because traditional financial reporting just does not tell a story. And it's one of those that, as I started becoming more interested in the consulting side of the business, I realized that the profession doesn't prepare us for that. We have to learn those things on our own. And so I went to the authority of that subject, which was our clients. Our clients couldn't express what they thought, but I looked at the two groups. Here's my clients who are successful. What is it that they look at? What's going through their head? But, because they're not trained financial people, they don't use the right terminology sometimes. So you got to dig in and say, what are you seeing? Why does this work for you? And it may or may not work for somebody else. But I also then looked at the other group, which is, as I always like to say, when all else fails, you can always serve as the bad example. And so what are the bad examples not looking at or looking at and making wrong decisions from? And kind of correlating those two things. And so studying the mind of the entrepreneur, because, really finance goes beyond numbers because it has a lot of emotion built into it. One of the things in the first book, Simple Numbers, Straight Talk, Big Profits, that I wrote in 2011, the first thing I hit in that book is your numbers are lying to you and you're the cause of it. And a lot of this is the entrepreneurial ego of, you want so desperately to tell everybody you're a profitable business that you basically cheat the numbers by not taking a market-based wage, and you get money out of the business in various other ways, depending on how the taxes work in whatever country you're in. But in every country, there's a way to get money out of the business and not count it as an expense so that you can prop up the profitability of your business. Well, that's not helping you. So we believe in kind of the truth serum of, hey, run your business in a way that the profit tells the truth. It's if you do work in your business, and 99.9% of all owners of the business work in their business. I get it. You want to work on your business some, but you've got to work in it, up till decent size. And what is the market wage that you got to pay somebody to do the job that you do? And that's not as hard of a thing to come up with, whether you pay it or not. I don't want to get off into the rabbit hole of taxation, but at least when I'm accounting for it, looking at the way that I see the analytical performance of the business, I need to include that in there. And the one thing I can tell your audience is 100% of the time that I've gotten the client to pay themselves a market-based wage out of the business and count it towards the profit of the business when they're evaluating it, they've not only made more in salary, but they made more in profit, because you're now looking at truth. You're now responding to an important data point that measures your worth as a business owner, because a business that's not profitable ain't worth much. There was a day back in the .com era that, you might have some businesses worth something that we had pre-revenue businesses back in that day, but that craziness came and went pretty quickly.
Yeah.
In these days, you've got to have something of value in that business, and that's usually measured by your ability to produce consistent profitability in most circumstances. A few rare outliers to that, but that's pretty consistent.
Yeah, I've never thought about that aspect to sort of more an ego and even a mindset, I guess, to that degree issue with business owners, because it's certainly not uncommon in my experience as well.
Yeah, well, you'll also see it a lot where people are in groups. So either you're in a trade association, you're in a group of other business owners. I'm in the Entrepreneurs Organization that has a forum. YPO has forums. Vistage has forum. I mean, there's all kinds of businesses that have these forum groups. And what I find, it is still amazing to me because I mean, a lot of times I know the actual numbers. And when I hear somebody start talking about their business that I know the numbers are not what they're saying, it's like, really? You're, but it is that thing of you just kind of get caught up in it. And and the other big one, is, the first word out of your mouth that we measure everybody against is revenue. Well, I got news for you. Revenue is worthless. I mean, it is about gross margin. Revenue minus your cost of goods sold. That's the true economic top line of your business. And we do not teach that in traditional financial circles. And it is just wrong. It is just absolutely wrong. And I make a point of this. If you look in the first book on page 22, I show a construction contractor compared to a services business. One of them, the construction contractor, has $20 million of revenue, and the services business has $3.7 million in revenue. But once you take out their cost of goods sold, they're exactly the same business from there down. And the thing is, if we would learn universally across all industries to filter everybody down to gross margin and then start comparing our business from there, we would create a massive leap in business clarity of financial performance. I've even kind of evolved to the point now that I really measure all clients on profit to gross margin rather than profit to revenue. It's just become such a clearer number that puts everybody on the same page.
Yeah, I totally agree. And I tend to introduce similar approach with clients I work with insofar as measuring to gross profit, not revenue.
Yeah.
It's that old saying, revenue's vanity, profit reality, and cash is king. Which is
that's absolutely. And so in that sense, so let's make sure, because I use the term gross margin, you use the term gross profit. There is a slight difference. So when I contributed one of the chapters to Vern Harnish's Scaling Up book, and when I was writing that chapter, I credit Vern with this, that he had this insight that he said, gross profit is a really bad term. I said, okay, all right, give me your thoughts. Why? And he says, the word profit is confusing. It really should. The word profit should be reserved for the bottom line of a business. And I said, I think you're right. And so from that point forward, I've always focused on the term gross margin, but the definition is slightly different than what most people use. We look at gross margin as revenue minus cost of goods that do not include labor. So it's only materials, subcontractors, other direct costs that are not your labor internally. Then we take gross margin minus your direct labor. That gets us to what we call contribution margin. So in most people's accounting systems that traditionally use the term gross profit, I'm not saying it's wrong, but I'm just saying for a point of clarity, I think Vern had a really good point. I like gross margin minus direct labor's contribution margin. And we call it contribution margin for a reason. Contribution margin is the margin that it takes to cover all of your non-direct activities, cover your overhead plus make a profit. And I contend that I would say contribution margin is actually the most important number on the P&L. I can get there three different ways. I can get more revenue. I can improve my cost of goods sold as a percentage to revenue. I can lower my direct labor. So I've got 3 levers to pull to get the contribution margin. Versus if I become overly focused on revenue, well, not all revenue is good. I can have revenue that I'll lose money. And unfortunately, we see that far too often than you may think. And so that's why it becomes super, super important to get clarity. And the other thing is we're firm believers, and you'll see this in our key metrics that we focus on, simple numbers, is all built around leveraging labor. There's nothing productive that happens in this world without the leveraging of labor. And so if you don't isolate labor, you can't actually calculate easily the most powerful ratios that it takes to run a business. And for your audience in particular, so you mentioned, hey, looking at that 5 to 30 employee, kind of company. When I teach this around the world, I said, listen, we're going to go to our most simplistic measure. It's called labor efficiency ratio, the total LER. And LER stands for labor efficiency ratio. All I've done is flip the formula to where gross margin is my numerator. All labor, doesn't matter what it does, is my denominator. 90+% of the businesses in the world operate on one standard. All you have to do is remember this one number, 2. Hopefully everybody can remember that. Most important number, 2. I'm going to get $2 of gross margin for every dollar of labor, regardless of what that labor does. I don't care if it's the CEO or the floor sweeper. And there's a handful of outliers on the higher side, a handful of outliers on the lower side. But like I said, 90+% of the businesses out there, especially in that 5 to 30 person, employee category, you're going to be a 2. And a lot of times the simplistic thing that I'll do in a presentation is I was doing a presentation up in the Northeast in the U.S. Last year, and a marketing firm was sitting there and she was struggling, with her business. And I said, okay, let's just simplify this. How much are you going to spend in labor next month? Everybody included, including you, the owner, at a market-based wage. So no cheating on your salary either. She said $50,000. This is great. Guess what? Your gross margin target for next month is $100,000. I guarantee you will be nicely profitable if you get $100,000 of gross margin for the $50,000 in labor that you already know today that you're going to spend. Doesn't take a genius to figure that one out. And I said, now here's the next question: have you sold enough work to do $100,000 of gross margin? She said, yes. This is great. Here's the next question: is your team sufficiently capable and processes in place to produce $100,000 of gross margin? She said, yes. This is great. You should be in perfect position to be profitable next month. She said, well, there is another problem. Okay. Well, we haven't finished the work that we previously billed for from other months prior that's getting in the way of the new work. And I said, that's a problem. And I said, there's only one way out. You got to still do your 2 to 1, and you got to ask your team to temporarily do something extraordinary. They're going to have to step up and clear the backlog of work and produce at the normal rate for at least a month. And then you'll be fine. And everybody can do that. You can do it for a month if you know that that's going to fix it on a permanent basis. Mm. Otherwise, you're always going to be a dog chasing your tail. And that old work that probably wasn't as profitable as you thought it was, and you've already spent the money because you had poor financial controls, that got you in trouble. You got to be, the cash and the producing's got to be, pretty tight in sequence on top of each other. I'm a fan of collecting money up front, but you better just set it aside and don't live off of it until you earned it. That's the safest way to do it.
One or more of these growth pillars standing in the way of you living the lifestyle you've signed up for? People, strategy, marketing, funding, or systems? We have a free ebook filled with actions and templates on each of these growth pillars. Download for free from our website, growasmallbusiness.com.
No, it's a great ratio, very effective, like you explained. So essentially, that should be at least one of the ratios that small businesses focus on.
Absolutely. Well, so there's another two. So I'll give you the two twos.
Yep.
So we'll call this episode the two twos. The first two is the $2 of gross margin for every dollar of labor. Now, let's talk about that sheet that nobody ever looks at called the balance sheet. Problem there, because most entrepreneurs look at that and their eyes roll back in their head and they go, I don't know what this means. Well, for very good reason, because we've done an awful job as the field of accountants in displaying an understanding of the balance sheet in an effective way. So here's at the end of the day, I'm going to just take all the noise out of the balance sheet and fix it for you. All you got to remember is one thing. I need 2 months. Here's our two. I need 2 months of operating expenses in cash and 0 drawn on a line of credit that tells me that I'm a fully capitalized business. If I get to those two numbers, 2 months of cash, 0 drawn on a line of credit, I'm fine. I'm fine permanently if I keep it there. Because now, if I've got the 2 months of cash, I hit my 2 LER every month, you're going to have a great business. Then your only question there is, can you grow it? Can you expand your market share? But of the work that you have, if you hit the 2 LER, if you hit the 2 months cash number, you're going to have a great business. Guaranteed. Never not seen it not work. Ever.
That's interesting.
And I've got enough gray hair to show I've been around a while.
So. Yeah, exactly. Why 2 months and not say 3 or 4? Or
it's interesting. Yeah, it's a great question. So when I came up with that number, I didn't just guess at it. I took a data set of our client, a data set that I was using to write the first book of our client data. And I studied it and I said, what is the deepest negative cash flow cycle any business sees in a 4-year period? I never saw a negative cash flow cycle worse than 2 months of cash. So I said, all right, let's use that. So I started using that number in about 2010. It has worked flawlessly. Here we are in 2024. I've never had a client need more than 2 months. I've had, what's funny was when I came up with that number, I was having a hard time getting clients to just have 2 months. Well, now once they had it and they have no line of credit debt, they're going, hey, maybe I need 3, maybe I need 4. No. When you have more than 2 months, you are overcapitalized, which means you have idle capital that's only earning you a rate of return of whatever your interest rate is of your overnight funds. So it's underperforming capital at that point. So in the U.S., we have our clients take that money out. When I'm working with my international clients, I have to be conscious of their tax system, of how we move money between entity and the owner and other things. And so you've got to be mindful of that. But in the U.S., we can kind of freely move it in and out of the business without taxation, once you're at that level. And because here's the thing, numbers have a behavioral outcome to them. So, one of the things they forgot to teach us in the world of accounting is I can list up all of the assets and all the liabilities and all the profit and all the income and expenses that you want. But to get those numbers to move, it requires humans to do it. Well, humans are very complex people that have a lot of emotions tied into every action. And one of the reasons why we actually segregate labor on the P&L, we never mix labor with something that's not labor, because labor is the only cost that comes to work every day with an attitude. It has good days and it's got bad days. And so we must measure labor's output on a consistent basis to really understand the health of the business. Well, same thing in terms of, looking at all of these other numbers in there, and that when we look at them, you want to, have the proper motivation. So if I have more than 2 months cash, what's the motivation there? I start taking the foot off the gas pedal and I lower my profitability because I feel comfortable having too much cash. And because I let off on the gas pedal, I erode wealth by lowering profitability. If I have we think 2 is the right number and I can maintain a good profitability number and all that's good. When I have less than enough cash, I start making bad decisions. I start offering discounts that are eating a margin that I really should be getting if I had plenty of cash and I could be patient and wait for good money and I wouldn't have to give a discount. We call that drunk driver rate financing when you give discounts, as a company. Oh yeah. I mean, it's just dumb because the average discount is an effective annual APR of 25% plus. It's like, well, that's not a good idea. Yeah. But desperate people do that. And I get it. I mean, we've had clients use it for a short period of time because they had no other choice. But the really good companies are the ones that are fully capitalized. They've got their cash. They're not living on a line of credit, and they're consistently profitable month in and month out. And the thing that I'll challenge people with when they ask for more than the 2 months cash number, I said, okay, well, set some aside personally, but get it out of the business. I don't want you seeing it in the business because it affects how you push against the rock every day. And so I've never had anyone put money back in the business that set it aside thinking that they needed more than 2 months. So I've had 15 years to test this theory. So far, 15 years in, I've never needed more than 2 months. Now, I'm not saying it couldn't happen, not saying that there's all kinds of businesses out there that it very well could be that somebody has one that does require more than that. I just hadn't seen it yet. And we see a lot of businesses around the world.
Yeah. That's some great insights there, Greg, for our listeners. And certainly those couple of key metrics, something our listeners, if they're running a small business, should focus on. So just to finish up, what's at least one thing you'd recommend a small business owner does from listening to our chat?
Well, I think first and foremost, we're about as easy to find as there is. I mean, there's not too many Greg Crabtrees in the world. If you Google simple numbers, you can see a ton of my podcast and interviews like this, examples, talks I've given. There's templates that are downloadable from the simplenumberscri.com website. And so the idea is, first and foremost, the takeaway is get your data in a simpler format. And we highly recommend our simple number structure. So get it in that format, understand, looking at profitability relative to gross margin instead of revenue, calculate the total labor efficiency ratio and see over time, is it getting better? Is it getting worse? And when I say looking at it over time, look at it on a rolling 12 calculation. Every month ending a 12-month accounting period, months are highly inaccurate periods of data. So we're firm believers in the rolling 12 presentation concepts. Rolling 3 is the second best, presentation from there. And look at those ratios of both profitability and LER from those. And then monitor that your capitalization. Understand you have a target of leaving capital in the business and don't take it out until I'm fully capitalized. But once I'm fully capitalized and I'm profitable, you have pretty much a consistent ability to distribute some cash and have investable funds either to grow the business further or diversify that investment into other things. Those are your choices. I don't make those choices for you. I just help you see them. And so that's the lather, rinse, repeat part of business that, you can take a business and turn it into a financial powerhouse by understanding those principles.
Yeah, no, fantastic takeaway. So love the chat, mate. There's some great stuff in there for our listeners, and appreciate your time, and maybe catch you in Tasmania if you get down here again.
Absolutely, loved it when I visited before, and especially the tiger snake that I got to stay away from as it was crossing the cart path, and the caddy said, "Hold up, we're going to let this snake through because I think I understand it's the third most deadly snake in the world or something along those lines." So
yeah, we look around with.
Nope, we gave him plenty of room. It said we got plenty of time. Let him it was just a beautiful countryside. I really enjoyed it.
Yeah, that's awesome. Thanks again, Greg.
We'd greatly appreciate you taking a couple of minutes to leave our podcast a review on iTunes. If you don't have an account, simply follow us on Spotify. You'll help other small business owners find the cast and valuable content our guests share.